Hello everyone and welcome back to the second of the Dillon Eustace Insights webinars on ESG. My name is Clodagh Barry and I will be moderating this afternoon's webinar. Our speakers today are Dillon Eustace partners Cillian Breeden and Aisling O'Malley from the Investment Funds team. Cillian is a specialist in investment funds and advises on a broad range of legal and regulatory matters. His clients include privately owned and institutional investment managers representing a wide range of asset classes. Cillian has also spent time on secondment in London within the legal department of a large US bank and in Dillon Eustace's Cayman offices. Aisling O'Malley is also a partner in the Asset Management and Investment Funds team. Her extensive experience includes a wide range of legal and regulatory matters, covering the structuring, establishment and regulation of all types of mutual funds, UCITS and AIFs, as well as advising and establishing and operating UCIT management companies and AIFs. Today is the second webinar in our two-part series on ESG. In our first webinar, Cillian and Aisling presented an overview on the new ESG framework applicable to fund management companies and funds. In this webinar, they will be taking a closer look at how these entities can prepare to comply with obligations imposed under the Disclosures Regulation, which will apply from the 10th of March 2021. Over the course of 35 minutes, Cillian and Aisling will take you through how a Supermanco might prepare itself and its funds under management for compliance with the Disclosures Regulation. Cillian and Aisling will present for approximately 35 minutes, finishing up with a 5-minute Q&A. The ground rules for today. Everybody is muted. We encourage you to submit questions via the Q&A function at the bottom of your screen, which we will call out at the end of the presentation. This session is being recorded, and without further delay, I'll pass you over to Cillian and Aisling.
Thank you very much for that kind introduction, Clodagh, and hello to everyone who has joined today's webinar. We are delighted to welcome so many of you back after our first webinar on ESG, which was held last month. Once again, we really do appreciate you taking the time out of your busy schedules to attend the second in our two-part series on ESG. As Clodagh mentioned, and as you will see from this next slide, today myself and Aisling will be doing a deep dive on those obligations imposed on a Supermanco under the disclosure regulations, which will apply from the 10th of March next year. Our key aim today is to provide you with some helpful and practical guidance on how best to comply with this upcoming obligation. To paint you a picture of this fictional client, our dual authorized UCITS and AIFMD management company, or Supermanco, is one which has both ESG funds and non-ESG funds under management. It operates on a delegated model basis, whereby it has appointed a number of both EU and non-EU investment managers to the funds under its management. It has chosen to opt up to report on principal adverse impacts of its investment decisions on sustainability factors. For those of you attending the webinar who do not have any ESG funds or who have already decided to opt out of the principal adverse impact reporting regime, we believe that this webinar will still be relevant to you. This is because it also tackles provisions of the disclosure regulations which apply to managers who do not manage any ESG funds. These obligations comprise of disclosures relating to sustainability risk on the website of these managers and the prospectus of the funds, addressing sustainability risk in the remuneration policy of the manager, as well as ensuring that sustainability related information contained in marketing materials do not contradict the disclosures made in the fund prospectus or on the manager's website. And for those of you attending with self-managed funds or SMICs or internally managed AIFs, it's important to bear in mind that when Aisling or I reference a management company or a Manco, this term equally refers to SMICs or internally managed AIFs. Finally then, just to note that we will refer to the disclosures regulations for the purpose of today's webinar. The Disclosures Regulation is also commonly referred to as the SFDR. In the next slide, we are setting the scene for what we are going to talk about today by highlighting the various actions that our Supermanco client will need to take in order to ensure that it is in compliance with the regulations by the 10th of March next year. In this respect, we'll be looking at the following 6 key actions for our Supermanco. Firstly, the classification process which our Supermanco needs to undertake. Secondly, how the Supermanco must analyse how sustainability risk is being incorporated into its investment decision-making procedures. Thirdly, the consideration of the Supermanco's remuneration structure with respect to sustainability risk. Fourthly, how the Supermanco considers the principal adverse impacts of its investment decisions on sustainability factors. Next, for the ESG funds under management, the steps for the Supermanco will need to comply with the additional prospectus and website disclosure obligations. And finally then, completing a consistency check to ensure marketing communications do not contradict the ESG information provided to investors via the prospectus and the website. Moving on then to the next slide, let's look at each of these obligations and how our Supermanco intends complying with each of them in a little more detail. Now, as you may recall from our first webinar, we noted that the purpose of the disclosure regulations is to provide for consistent disclosure requirements in relation to sustainability across all EU member states by financial market participants. As mentioned earlier, the regulations apply from the 10th of March 2021, and under these regulations, the European Supervisory Authorities, or ESAs, were tasked with preparing draft regulatory technical standards, which will take the form of a Commission delegated regulation once finalised. This is also referred to as Level 2 measures. The purpose of Level 2 measures is to provide entities with further clarity on how they are expected to comply with the provisions set down in the principal regulations, often referred to as Level 1 measures. Level 2 measures are therefore intended to put the meat on the bones, if you like, of the relevant obligations set down in the disclosure regulations. Now, normally, and as you might expect, Level 2 measures typically enter into force on the same date as the Level 1 measures. However, this isn't the case for the disclosure regulations. The Level 2 measures will not be ready for implementation by the 10th of March next year. This is as a result of delays to the consultation process due to the COVID pandemic. While we do not yet know when the Level 2 measures will enter into effect, my current guess will be the 1st of January 2022. Now, what this means for you is that there may be a two-stage compliance plan under the disclosures regulation. This is best illustrated when we look at the next slide. As you'll see from this slide, certain of the obligations under the regulations do not have any corresponding Level 2 measures, and so must be complied with in full on the 10th of March 2021. These are as follows. Firstly, website and prospectus disclosure obligations relating to the integration of sustainability risks into the investment decision-making process. Secondly, disclosure on integration of sustainability risk in the remuneration policy of the manager. And thirdly, the obligation to ensure that marketing materials do not conflict with ESG disclosures contained in the fund's prospectus and the manager's website disclosure. The prospectus disclosure obligations relating to ESG funds set down in the regulations have corresponding Level 2 measures, as do the disclosures relating to principal adverse impact reporting, where a Manco is required to or chooses to comply with these disclosure obligations. The European Commission has indicated that when complying with Level 1 measures under the regulations, which do not yet have Level 2 measures available, these should be complied with using high-level and principle-based disclosures. But what in fact is an ESG fund? By way of reminder, we've included this next slide to explain the two types of ESG funds under the disclosure regulations. As you will see from this slide, an Article 8 fund or light green fund is one which promotes environmental or social characteristics, although not exclusively, and which invests in companies that follow good governance factors. An Article 9 fund or dark green fund, however, is one which has as an objective either sustainable investments or reducing carbon emissions. Moving on then to the next slide, as you'll hopefully recall from our first webinar, in order to determine which obligations apply to you as a management company, you will need to undertake a classification process. In short, these are the questions our Supermanco needed to consider as it looked across its fund range in order to determine the impact of the regulations. Firstly, do I manage any ESG funds? If the answer is no, then only Articles 3 to 7 and Article 13 of the regulations will be relevant. If the answer to that question is yes, then the next question is whether these funds can be categorized as Article 8 or Article 9 funds, which I've just described. If the answer to that question is yes, then Article 8, 9 and 10 of the disclosure regulations will be relevant, as well as Articles 3 to 7 and 13 of the regulations, which impact non-ESG funds too. Again, to emphasize, one of the key takeaways from today's webinar is that this classification exercise is something which all managers will need to carry out in order to assess the impact of the disclosure regulations on them and the funds that they manage. Finally, just to note, for the purposes of today's webinar, we will be focusing solely on the disclosure regulations, given that this is the first deadline which you will need to meet. Therefore, we are leaving the taxonomy regulations and all that entails until another day. And with that, I will now hand you over to Aisling, who will bring you to how our SuperManco client is dealing with the prospectus disclosures around the integration of sustainability risk and the impact on its remuneration policy.
Thank you, Killian, and again, a warm welcome to you all. Turning now to the first of the obligations which Killian mentioned, which relates to how management companies integrate sustainability risk into their investment decision-making process. Firstly, and before we get into the specific disclosure requirements, let's just remind ourselves of the definition of sustainability risk. Sustainability risk is defined as an environmental, social, or governance event or condition that, if it occurs, could cause an actual or potential material negative impact on the value of the investment. This addresses whether or not a portfolio manager, when making investment decisions and building their portfolio, considers whether the value of an underlying investment could be materially affected by an ESG event. Some examples of an ESG event might include the risk that the value of shares held in an investee company falls as a result of stranded assets or breaches of employment law or labour standards, for instance. This additional disclosure is intended to increase investors' awareness of the sustainability risks posed by individual funds. As Killian highlighted in an earlier slide, disclosure requirements relating to the integration of sustainability risk do not have any level 2 measures, and therefore compliance in full is required by 10th of March next year. What this means in the context of website and prospectus disclosures is that by the 10th of March, each management company must disclose on their website information about their policies on the integration of sustainability risks into their investment decision-making process. And the prospectus of each fund under management must also provide information on the manner in which sustainability risk is integrated into the investment decision-making process. Moving on then to the next slide. This slide details a step plan which our SuperManco has put in place in order to address its obligations as regards the integration of sustainability risk into its investment decision-making process. Firstly, our SuperManco intends to review its existing due diligence policies, which of course it already maintains under existing legislation, and in conjunction with the relevant portfolio managers, it will update these policies to outline how sustainability risk is taken into account in the investment decision-making process, both at the construction stage and also during the life of the relevant fund. In our case, because the SuperManco has appointed delegate investment managers, it will need to engage with those delegates to obtain appropriate information on how they integrate sustainability risk into their investment decision-making procedures. Or alternatively, our SuperManco may require such delegates to comply with its policy on the management of sustainability risk. Whilst this will of course vary from management company to management company, for our SuperManco, sustainability risk is integrated into the investment decision-making process in the following way. Our SuperManco will consider the ESG data which the relevant portfolio manager obtains from third-party data providers to assess the sustainability risks associated with the investment. Our SuperManco will also consider the fundamental analysis conducted by the portfolio manager prior to acquiring an investment in order to assess the sustainability risk posed by the investment, as well as considering how the issuer manages sustainability risk that it faces. Our SuperManco plans to monitor sustainability risk during the life of the relevant fund by using ESG information published by the issuer itself and/or by monitoring ESG information on the issuer from third-party data providers. The policies of our SuperManco will also detail the action which might be taken by a portfolio manager on foot of such information. For example, the data might encourage the portfolio manager to remain invested, or alternatively, to consider a sale of the investment if it's the case that the sustainability risk associated with that investment has risen beyond the sustainability risk appetite which our SuperManco has set for the relevant fund. Once our SuperManco has updated its due diligence policies in conjunction with any delegate investment manager, the investment management and risk management teams of our SuperManco will then need to turn their attention to assessing the likely impact of sustainability risk on the return of each fund under management. And this information needs to be disclosed in the prospectus of each fund. The recitals to the disclosures regulation note that this can be disclosed either in qualitative or quantitative terms. Therefore, our SuperManco intends to rely on qualitative terms and explain to investors in the prospectus that the sustainability risk associated with the relevant fund is material or moderate or low, for example. Given the asset class of one of the funds under management, our SuperManco intends to explain in the prospectus as to why sustainability risk is not deemed relevant for that particular fund. Once our SuperManco has conducted the analysis we have described and prepared the revised policies and website disclosures, these must be reviewed and adopted by the board of directors of our SuperManco and the relevant disclosures added to its website by the 10th of March next year. With regard to the draft prospectus disclosures, these should also be presented to the board of directors of our SuperManco and the board of directors of the relevant fund for their consideration. Our SuperManco will then arrange for the finalised prospectus for each fund under management to be filed with the Central Bank under its fast track approval process, which the Central Bank has recently agreed to facilitate and the details of which will be finalised in the next while. And where relevant, filed with regulatory authorities in jurisdictions where the relevant funds are registered for sale. Our SuperManco will then arrange for the new prospectus for each fund to be uploaded to its website and distributed to internal teams and external distributors. Our SuperManco has also decided to update the relevant investment management agreement with each delegate investment manager to ensure that the delegate is contractually obliged to provide all relevant information and assistance which is required by our SuperManco to comply with its obligations under the disclosures regulation. Given that its UK delegate investment managers will not be subject to the disclosures regulation once the transition period expires, our SuperManco is particularly concerned with revising its agreements with these managers and indeed any other non-EU managers. Moving on then to the next slide. This addresses the disclosure requirements as they relate to remuneration policies. The remuneration policy of a management company must be updated to disclose how it is consistent with the integration of sustainability risks. The purpose of this is to provide investors with information on how the remuneration policy promotes sound and effective risk management with respect to sustainability risk. The recitals to the disclosures regulation note that the structure of remuneration should not encourage excessive risk-taking with respect to sustainability risk and should be linked to risk-adjusted performance. To note, there are no Level 2 measures to provide further clarity on how management companies are expected to comply with this requirement. For the purposes of this case study, the remuneration policy of our SuperManco will be revised to explain how the variable or bonus component of the pay of identified staff is and can be adjusted to take into account current and future sustainability risks. In this way, the remuneration policy of our SuperManco will explain how the pay package of identified staff does not encourage them to take excessive sustainability risk. Turning then to the next slide. We've set out the steps being taken by our SuperManco to address disclosure requirements as they relate to its remuneration policy. Whilst the step plan is short and sweet, the first step is a key step as it relates to the assessment which our SuperManco must conduct on how sustainability risks are integrated into its remuneration structure. It's only when this assessment has been conducted will our SuperManco then be in a position to update its remuneration policy accordingly. And of course, the updated remuneration policy needs to be in place by the 10th of March next year. Now that we've considered the disclosure requirements relating to the integration of sustainability risk into the investment decision-making process and all that that entails, Cillian will now focus on the disclosure requirements relating to principal adverse impact reporting.
Thank you, Aisling. Now, turning to the next slide, we'll be assessing the impact of Article 4 on our Supermanco. As listeners may be aware, Article 4 of the regulations require management companies to address the issue of principal adverse impacts of investment decisions on sustainability factors. Again, a reminder at the outset that this obligation arises even where the management company does not manage ESG funds. While sustainability risk is inward-looking and considers the impact of an ESG event on the value of the fund, principal adverse impact reporting is outward-looking, in that the requirement relates to assessing how the investment decision can impact on the sustainability factors. Sustainability factors are defined as environmental, social, and employee matters, respect for human rights, anti-corruption, and anti-bribery matters. In other words, what impact is a Manco's investment decisions having on the environment and society? As we know, management companies with an average number of 500 employees or more, or those who choose to opt up voluntarily, must disclose on their website information on their due diligence policies with respect to principal adverse impacts on sustainability factors. As touched upon already, the Level 2 measures will not enter into force on the 10th of March next year. This means that Mancos who either must comply or choose to opt up to comply should adhere to the obligations set down under Level 1 using high-level and principles-based disclosures. It is also worth highlighting at this juncture that this obligation is subject to a proportionality standard. This means that the management company's size, nature, and scale of activities and the types of funds it has under management should be taken into account when complying with this obligation. In other words, a small management company with, for example, 3 plain vanilla long-only equity funds under management does not necessarily need to comply with the disclosure obligations in the very same way that a large investment firm with a large number of complex funds under management would, for example. So what does our Manco client need to address under Level 1 in relation to principal adverse impact reporting? We've set these out on the next slide, and the obligations are as follows. Firstly, our clients will need to provide information on their policies and how they identify and prioritize principal adverse sustainability impacts and indicators. Secondly, they will need to give a description of the principal adverse sustainability impacts and any actions taken or planned in respect to such impacts. Thirdly, our clients will need to set out a brief summary of the engagement policies required under the Second Shareholder Rights Directive, or SRD2. And finally then, there will need to be a reference to adherence to responsible business conduct codes or internationally recognized standards for due diligence and reporting, and where relevant, the degree of alignment with the objectives of the Paris Agreement. Moving on then to the next slide, we have set out the steps that our Supermanco will need to follow to ensure that it meets its obligations under Article 4 in relation to principal adverse impact reporting. Now, on the basis of this step plan is quite self-explanatory, we thought it would be beneficial to highlight to you, the listeners, some of the key issues that our client faced when looking to take these actions to ensure compliance with this element of the disclosure regulations. Firstly, in the case of our Supermanco, which only has a handful of employees and no subsidiaries, it does not currently fall within the scope of the Non-Financial Reporting Directive, or NFRD, and so is not required to include non-financial information in its annual financial statements. However, for commercial and reputational reasons, our client wants to opt up to comply with Article 4 disclosure obligations. It's concerned that as a manager of ESG funds, to include a statement on its website that it does not consider adverse impacts of investment decisions on sustainability factors would give investors the impression that it isn't serious about its commitment to sustainable investing. Therefore, it will need to consider including high-level disclosure on how it identifies and measures whether or not investments within the portfolio could have a principal adverse impact on sustainability factors. This is both prior to investment and during the life of the fund. Article 4 references the use of indicators for such purposes. Now, while the draft Level 2 measures set down 32 mandatory indicators for such purposes, the disclosure regulations itself does not set out any indicators which must be used. Therefore, the Supermanco in our case study is considering referencing indicators such as those set down by IFAMA in its response to the consultation on draft level 2 measures. In that response, IFAMA suggested using 6 key indicators, for example, 4 on environmental matters and 2 on social and employee matters. Our Supermanco also intends to include some high-level information on actions it has taken to date in respect of its investee companies which generate sustainability concerns. This includes how it discharges its stewardship responsibilities and other shareholder engagements, including, for example, voting, dialogue with investee company, cooperation with other shareholders, etc. Our Supermanco has begun to engage with its delegate investment managers in order to ensure that it is in a position to comply with Article 4 by the 10th of March 2021. And in that respect, it intends to update its delegate investment management agreements to contractually oblige its delegates to provide reasonable assistance to it so that it can comply with its obligations under the regulations. And while our Supermanco has now taken the decision to comply with Article 4 disclosures in full, it did consider explaining rather than complying. We advised that in such circumstances, it would need to disclose on its website why it does not consider principal adverse impact reporting, including where relevant information as to whether and when it intends to consider such adverse impacts. We advised that this could include explaining why an assessment of the impact of investment decisions on sustainability factors taken by the Supermanco or its delegate are simply not relevant for the type of fund under management. We also advised them that we are aware of other management companies who do not manage ESG funds and who intend to disclose that they do not currently monitor the principal adverse impact of investee companies on sustainability factors, given that they do not market their funds under management as either sustainable or green. So with that, I will now hand you back over to Aisling, who will bring you through how our Supermanco is complying with the prospectus disclosure requirements for its ESG funds.
Thank you, Cillian. Before we look at the prospectus disclosure requirements for ESG funds, let me firstly set the scene for the purpose of this case study. So in this instance, our Supermanco has gone through its classification process and it has concluded that it already has a number of ESG funds under management, both Article 8 funds and Article 9 funds. In conjunction with the relevant delegate investment manager, a decision has also been made to convert an existing non-ESG fund to an Article 8 fund. As Cillian mentioned in an earlier slide, Level 2 measures will be published, which will provide further detail on how the disclosure obligations under Article 8 and Article 9 should be complied with. However, because these will not be published by March next year, the European Commission has advised that management companies only need to ensure that high-level and principles-based disclosures are included in a prospectus. In the case of our Supermanco's existing Article 8 and Article 9 funds, it will need to review the existing investment policies and determine whether the disclosures already satisfy the disclosures obligations set down under Article 8 and Article 9 respectively, or whether some updates to the existing disclosures will be required. In the case of the fund which will convert to an Article 8 fund in order that it can be marketed as sustainable, the fund supplement will certainly require updating. Our Supermanco must also consider whether it intends designating an index as a reference sustainable benchmark for any of its Article 8 or Article 9 funds. And the purpose of the reference sustainable benchmark is essentially to measure whether the relevant financial product is meeting its environmental characteristics or, where applicable, sustainable investment objective. Whilst there's no obligation to designate a reference sustainable benchmark, in our case, our Supermanco has decided to include new reference sustainable benchmarks for each of its Article 8 funds, meaning that the relevant supplements will require updating in line with the disclosures regulation. Our Supermanco will also need to consider whether any changes need to be made to the KIDs in light of changes being proposed to the prospectus. Of course, an important part of this whole process is to determine whether any changes being made to the fund documentation will trigger shareholder approval or advance shareholder notification. If our Supermanco determines the change to the investment policy to be non-material in nature, then in that instance, no advance shareholder notification is required, and investors can be notified of such changes in the next set of periodic reports. However, if there is any change to the investment objective of the relevant fund or a material change to its investment policy, requisite shareholder consent must be obtained, and the shareholders must be provided advance notification of such changes in order to allow them to redeem prior to those changes being implemented. As already mentioned in the context of prospectus updates generally, and just to recap, the revised prospectus disclosures should be presented to the Board of Directors of the management company and the Board of Directors of the relevant fund for their consideration. The updated prospectus will be filed with the Central Bank and other regulators as applicable, and once noted by the Central Bank, it will be uploaded to our Super Manco's website and circulated to relevant internal and external parties. Our Super Manco has also decided to revisit the investment management agreement in place with any delegates to ensure that they are contractually obliged to provide such assistance as is necessary to allow our Super Manco to comply with its obligations under the Disclosures Regulation. Moving on then to the next slide on the requirements in respect of website disclosures for ESG funds. Because our Super Manco manages ESG funds, it will be required to update its website to include specific information relating to those ESG funds. Whilst Level 2 measures, once issued, will set down in detail the type of information to be included on the website, the Disclosures Regulation already sets down specific categories of information to be disclosed on the website. Whilst there is certainly some overlap between the information that must be included in the fund prospectus on the one hand and on the website on the other hand, Article 10 of the Disclosures Regulation does require some additional information to be provided solely on the website, with the intention being that this information can be easily updated if and when necessary. Our Super Manco must therefore engage with internal teams and delegate investment managers to gather information on data sources, screening criteria for underlying assets, and relevant sustainability indicators, which Cillian already spoke to, which will be used to measure environmental or social characteristics or the overall sustainable impact of the financial product. Once all of this information has been collated, our Super Manco must present its suggested website disclosures to its Board of Directors for their consideration and approval. More generally, from the 10th of March next year, our Super Manco must ensure that all sustainability-related disclosures on its website are kept up to date at all times. Moving on then to the next slide, and this serves to remind us that marketing communications must not be overlooked. Once the prospectus disclosures and website disclosures have been finalised, our Super Manco intends to conduct a review of all of its marketing materials relating to funds under management to ensure that the information contained in those marketing materials does not contradict the ESG related information contained in the relevant prospectus and on its website. The next slide details our Super Manco's step plan for its marketing communications. Our Super Manco is currently carrying out an inventory of all fund marketing materials and will arrange for a consistency check to be carried out once the website and prospectus disclosure requirements are finalised. We've reminded our Super Manco of the obligations imposed on it under the cross-border regulation, such that from the 2nd of August next year, it will be required to ensure that all marketing communications are identified as such, that they provide a description of the risks and rewards of purchasing shares in the relevant fund, and that they contain information which is fair, clear, and not misleading. In this regard, it's interesting to note that under the draft ESMA guidelines just recently published by ESMA on marketing communications, they provide that the sustainability-related information should be commensurate with the extent to which the strategy promotes ESG characteristics or objectives. Moving on then to the next slide, we will consider how our Super Manco interacts with the Board of Directors of an externally managed fund. Whilst it's the management company which is the entity which is required under the Disclosures Regulation to ensure that all relevant disclosures are included in the prospectus of each fund under management, It is the board of directors of the externally managed fund who is responsible for issuing the prospectus and therefore must approve any changes to the prospectus. Accordingly, our SuperManco intends to present to the board of directors of the relevant externally managed funds on its approach to complying with relevant obligations arising under the ESG framework in order to give that board adequate background information to the prospectus disclosures that they are ultimately being asked to consider and approve. Our SuperManco's presentation will provide an overview of the following: the classification process which it, in conjunction with its delegate investment managers, has conducted in order to classify each relevant fund as either an Article 8 fund, Article 9 fund, or non-ESG fund. In the case of Article 8 and Article 9 funds, our SuperManco will provide an overview of the ESG strategy pursued by the relevant fund. The presentation will also detail the approach taken by our SuperManco with respect to the integration of sustainability risk in the investment decision-making process and principal adverse impact reporting. Our SuperManco will explain the background to the draft prospectus disclosures being presented to the board of the externally managed fund for their consideration and approval. And finally, our SuperManco will provide an overview of its approach to the review and revision of marketing communications which relate to the relevant funds to ensure that the disclosures are consistent. Our SuperManco will also arrange for representatives from relevant delegate investment management teams to be available to answer any questions during the presentation. Whilst the board of the externally managed fund does not need to concern itself with the remuneration policy or website disclosures of our SuperManco will of course be happy to provide an update on same if so requested. That then concludes a brief summary of the disclosure obligations being posed on ESG funds. Back now to Cillian, who will conclude with a number of key takeaway points.
Thank you, Aisling. Now, we appreciate that there's been a good deal of information to take in with respect to bringing you through how our SuperManco is dealing with each of the requirements of the regulations. So we thought it would be useful to summarise the 6 key actions and steps taken by our SuperManco in this regard to ensure compliance by the 10th of March 2021. Firstly, our manager needs to carry out a review of all funds under management to determine whether or not they constituted an ESG fund. This step was critical as it determined the scope of the disclosures which will need to be made. Secondly, our client then discussed with the relevant investment management and risk management teams to understand how sustainability risk was currently being incorporated into the investment decision-making process. As we've outlined, information on this will need to be disclosed on the manager's website and in the prospectus of all funds under management, regardless of whether or not they are ESG funds. Thirdly then, our manager needs to consider its remuneration structure and revise its remuneration policy to explain how it does not encourage excessive risk-taking with respect to sustainability risks. Information on the revised remuneration policy, once adopted by the management company, must then be uploaded to its website. Fourthly then, they needed to determine whether they wanted to disclose information on how they consider the principal adverse impacts of their investment decisions on sustainability factors. Excuse me. As discussed, smaller managers can choose to opt out of this disclosure obligation, but must still update their website to explain why they do not consider these impacts and where relevant, whether and when they intend to consider them in the future. Next, as our management company had ESG funds under management, it needs to conduct a review of existing prospectus disclosures and revise them as necessary to comply with Article 8 and Article 9 disclosures as relevant. The management company's website will also then need to be updated to disclose the ESG specific information. Finally then, a consistency check needs to be carried out in order to ensure that any ESG related information contained in the marketing communications did not contradict the ESG related information provided to investors via the prospectus and the website. So those are the 6 key actions, and that brings us to the end of our presentation. So with that, I'd like to thank you again for listening, and I'll now hand you over to Clodagh for the Q&A section of today's webinar.
Thank you very much, Cillian and Aisling, for those insights and sharing the ESG case study. We now have 5 minutes for questions. I'm going to go to the first question that's coming up here today. So for my Article 8 and Article 9 funds, Do I need to update my UCITS KID? And that one is for you, Killian.
Thank you, Clodagh. Yes, that's a good question. It's a question a number of our clients have actually asked. So there is no obligation under the regulations to update either your UCITS KID or your PRIP KID. However, you'll need to consider whether the KID should be updated if it's the case that the investment objective and policy, for example, of the relevant fund is changing in order to classify that fund as an Article 8 fund or an Article 9 fund. So as listeners will be aware, this is to ensure that the provisions of the KID are consistent with the provisions of the revised prospectus. So hopefully that answers that question.
Thank you, Killian. The next question, so under its investment policy, one of my funds cannot invest in munitions companies or tobacco companies. Does this render them an Article 8 fund? And I'm going to give that one to you, Aisling.
Thank you, Clodagh. If it's simply the case that the investment policy of the fund is stating that it doesn't permit investment in tobacco companies or munitions companies or such like, and more importantly, the investment policy doesn't contain any other information with regard to an ESG related strategy or doesn't make claims about pursuing an ESG related strategy, then in that instance, no, I don't believe that the exclusion alone should bring the fund within the scope of Article 8 disclosure requirements. But I would stress that obviously the investment policy as a whole and any detail around its investment strategy does need to be considered in full to ensure that there is no additional information which could possibly bring it within scope of Article 8. So hopefully that gives a bit of a steer.
Thanks, Aisling. I'm very conscious that we're not going to get all the questions that are coming up today. And in the interest of time, I would like to thank Killian and Aisling for their presentation on the ESG case study today. If anyone has further questions or would like to discuss any issue relating to ESG funds, please reach out to Killian and Aisling. Their contact details are now on screen, or call your usual Dillon Eustace contact. The next Dillon Eustace Insights webinar is proposed for January 2021, and we will be in touch near this date with the details. We will circulate a copy of today's presentation to the attendees, and we will post today's webinar on the Dillon Eustace website over the coming days. So look out for a notification on this on the Dillon Eustace LinkedIn page. So thank you for your time today, and goodbye for now.